This book right here completely changed how I think about investing. Written by Dr. William Bernstein, this book is a cold, hard look at the facts of investing in stocks and bonds and the nuances of the financial industry. If you want to learn how the stock market actually works and why we invest the way we do, I highly recommend it. Hi, I'm Dr. Shamim Nazir. Today I'm sharing my key takeaways from this book so you can start applying these concepts right now. So first of all, who is Dr. William Bernstein? Well, he's a neurologist turned financial expert. He's one of the most respected voices in the financial world, and this book is a must-read for anyone who wants to invest intelligently. So let's get to my key takeaways. Number one, oversaving is never a problem. And as Bernstein says, if you can't save, don't bother learning about investing. I know that sounds really harsh, but your savings has more impact on your financial future than investing ever can. And the definition of investing is the deferral of current consumption for future consumption. So that deferral needs to happen for us to be able to invest and grow and have something for the future. And you might think that too much saving will deprive you of all the fun things in the present, but honestly, it will reduce your present stress and ensure that you have a good future. So don't hesitate to automate your savings into an investment account because that's going to be your best bet. And don't be fooled by the conventional advice to buy a home as an investment. This is the next point he makes, is that your home is not an investment. Your home is a consumption item. And in the book, he explains how to compare investing in a home versus investing in the stock market or another investment. Your imputed rent, which is the rent you would be paying if you didn't own a home, is your return on that home. It's the dividend you're earning on your investment. So for instance, if you purchase a home for $300,000 and your mortgage is $1,250, your return is that $1,250 divided by 300,000 or 5%. And then you've got to subtract 3% for taxes, insurance, and maintenance costs, which leaves you earning 2% on your investment by buying that home. And a good rule of thumb, he says, is to never pay more than 15 years of fair market rent for any home. And speaking of returns, even experts make this next mistake of reporting past returns as future returns. So the third takeaway is historical returns do not predict future returns. A lot of resources show that the stock market has generated 10 to 12% annually since 1925. However, Bernstein says no one has actually made those returns. Those are theoretical returns. And these numbers do not include commissions or fees. So whenever people tell you that you'll earn 10 to 12% over the next decade or more, don't bet your nest egg on it. And if that didn't crush your hopes, the next one will definitely cause you to pause. And that is, whenever you're considering your returns, always think in after inflation values. He states that after inflation, the real return for the S&P is 4%. This return is much lower than what we hear from other sources. And furthermore, if you are purchasing bonds, they are more likely to lose value with inflation because they have a fixed face value and a fixed return. Whereas stock prices can keep pace with inflation because companies can raise the price of their goods and services. So how can you take better returns? Take more risk. And that leads us to number 5. You cannot expect high returns without risk. And this is what we call the risk premium. You're getting paid for the risk you're taking. In fact, the promise of high returns without risk should make you cautious. But if you're overly concerned about risk and you don't invest, you are doomed to low returns. But don't sweat it. The more important than the degree of risk is time. So that takes us to our next takeaway, that time in the market is more important than timing the market. It's not a particular stock or a sudden rise in the market that's going to determine your returns. It's the compounding of those returns that has the greatest effect. So make sure you invest for the long term. Investing in the stock market is not for 2 to 5 years. It's for more than 10 years. Do not use funds that you might need in the next few years, and don't change your allocation or your strategy more than once every few years. So if you're in it for the long haul, how will you invest? And that's the next step. That's called asset allocation. Asset allocation is a process of dividing the investment portfolio among different asset categories such as stocks, bonds, and alternatives. And it's based on their correlation to each other. For example, stocks and bonds have low correlation. And what that means is that the two assets are not influenced by the same factors. So they don't rise and fall together. As stocks decline, bonds will hold steady. And that will protect your portfolio from total loss. Asset allocation is usually a two-step process. The first step is deciding the allocation between stocks and bonds. How much should you put in stocks and how much in bonds? The general rule is that the bond allocation should be equal to your age. So if you're 70 years old, you want to have most of your portfolio or 70% of your portfolio in bonds. However, if you have other sources of income, this may not be necessary. And step 2 is the allocation of stocks. And he recommends 70% in the US market and 30% in foreign markets. And a more complex allocation strategy would divide those US stocks between large, mid, and small cap stocks, and the foreign allocation between developed and emerging markets. Now, after you've decided the stock and bond mix, you want to diversify. And that takes us to the next point, number 8, diversify as widely as you can. Even though most market returns come from a few large companies, it's still best to diversify further. And you could do this yourself, but it's not advisable. So index funds are a good way to diversify. Index funds are market cap weighted, meaning that the index fund holds a given company according to the dollar value of all shares. And if a company's stock quadruples relative to the rest of the index, so does its share of the index and any other index fund that tracks it. So avoid focusing on any one stock and view the portfolio as a whole. And despite these fairly simple and straightforward rules, people are not good investors. We are emotional creatures driven by envy, greed, and competition. One of the ways we fan the flames of envy is through stories. And that takes us to the next big takeaway, which is that human beings love great stories. We like easy to understand narratives. Instead of diving into the details, we want to be entertained. It's so much more fun to own a glamorous stock like Netflix than a mundane manufacturing company. However, that manufacturing company is likely to be much more profitable. The more exciting a stock or asset class is, the more likely it's overpriced, overowned, and destined for low future returns. And similarly, the fastest growing foreign market is not the best investment. Sometimes in these countries, new shares are issued readily, and this dilutes the price per share. And they also don't protect their investors from the managers who take advantage of the system. In general, people watch the news or hear things from their neighbors and friends about an exciting new stock or fears of recession, and they react by buying or selling. Of course, by the time the word is on the street, it's not a good idea. It's too late to take advantage of that change. So it's best to stay the course. So the main point here is that number 10, markets are unpredictable. Humans are generalists. We look for patterns where there are none. And this is especially true of the stock market, which means you can't outguess the market, not consistently. Even big hedge funds, which have made successful predictions in the past, cannot consistently time the market. And these professionals have been in the financial industry and have access to the best information and the best research. So individual investors like you and I don't stand a chance. Furthermore, it's been proven multiple times that passively managed funds do just as well or better than actively managed funds. And that takes us to the next lesson. Don't try to pick stocks. 90% of the stock market volume is done by institutions, which are deeply committed and well prepared, with analysts working around the clock. So you don't want to compete against them. Your only defense is to be consistent and think long term. And that takes us to our next point, which is to be disciplined about buying low and selling high, which means buying stocks that are falling. And of course, that's really hard to do emotionally. And that's why you want to create a plan and stick to it. So a couple of the methods discussed in the book are dollar cost averaging and value averaging. For the lay investor, dollar cost averaging is much simpler and easy to implement. So how does dollar cost averaging work? Well, it means you invest the same amount every month. So let's say it's $100. Well, obviously, if the share is priced low, you'll get more of them. And if the share is priced higher, you'll get fewer of them, which is exactly what you want to do. So you're buying more at a lower price. So here's a table to illustrate how this works. Month 1, you're investing $100 and you're purchasing 15 shares for that $100. So month 2, you're still investing $100, but now the price has dropped. So instead of getting 15 shares, you're getting 20 shares. And then month 3, the price goes back up to $10 and you're getting 10 shares. So the average price per share, which in this example is $8.18, is actually lower than the average price for 3 months, which is $10. Dollar cost averaging forces you to invest equal amounts periodically. So it lowers the cost overall and increases your overall return. Value cost averaging is more complex and requires a lot more attention. And in value averaging, you're looking at the asset value and then you're changing your investment amount amount in that particular asset based on the value and not a fixed investment amount. So you're guided by not the investment dollar, but rather the value of that stock. Number 13 is one that Dr. Bernstein in his book talks a great deal about, and that is to be cautious of the financial industry. Any stockbroker, any full-service brokerage firm, and any advisor who purchases individual securities, and of course any hedge funds, because federal and state laws do not regulate brokers as they do a lot of other professions. They are not a fiduciary. A fiduciary means they are putting the interest of the client first, and these brokerage firms are not fiduciaries. So they don't necessarily have to have the client's interest first. So as he points out, these brokerage firms have a conflict of interest. They have the firm or the fund on one hand, and their clients or investors on the other. And the firm makes money at the expense of their clients. So investors are better off purchasing index funds at low fees instead of hiring an advisor and paying him 2% per year. And the other thing he says to be wary of are things they might sell you as special stocks, because those are usually those stocks that are rejected by institutional investors. And bonds that they might sell you are those that they bought at a discount rate and are now selling to their clients. He states mutual funds are a bit better because they have greater transparency and they actually have specialized managers. But even here, they are paid by assets under management. Their primary focus is growing their funds, not your returns. However, they do report their performance and their fees, so they might be a better place for you to invest. Now, you have to watch out that they may be directing you to their own affiliate brokerage or their own fund that they can benefiting from. A fund company's attention is on their bottom line, their earnings, not your earnings. And that's why he says it's better to invest with a nonprofit or privately owned mutual fund company. Now, the next big takeaway that we don't pay much attention to is Social Security. Social Security can be an important piece of the retirement puzzle, and we need to understand how it works and how we can leverage that. As he points out, delaying your Social Security can be very beneficial. If you delay it to age 70, this would add an extra 8% yield for every year that you wait. And waiting comes in handy with investing. The next takeaway is buying and selling costs money, and the less you do of it, the better. So don't rebalance too often. Rebalancing once a year or every few years even is the best practice, because rebalancing is not done to get better returns. It's really to reduce your risk. The excess returns generated will likely be like 1 or 2%, but the capital gains you'll pay by selling that stock are much higher. Of course, if you're rebalancing on a tax-deferred account, it may not be a consideration. The main reason, again, to rebalance is to reduce your exposure to stocks. So if you see that the values in your stock portfolio rise and your stock bond split is more than 10% from where you want it, you may want to rebalance to reduce your risk. Now, the next takeaway was also very interesting to me because I know ETFs are very popular, but he brings up a couple of pitfalls of using ETFs. People use them because they have lower fees and they're more tax efficient, but they can incur costs with trades and commissions and buy-sell spreads. And secondly, the convenience of trading with ETFs could be a disadvantage if you're an emotional investor. And this brings us to number 17, the hidden cost of investing, which are fees. These are not mentioned when they're citing your returns, and your fees will be subtracted from your returns. So some of these are necessary for the management of the fund or the business, but minimizing these fees will really help you maximize your returns. So what are some of the common fees? There can be advisory fees. This is the fee charged by a financial advisor or institution for providing investment advice, and it's often calculated as a percentage of assets under management. And then you have expense ratios. Mutual funds and ETFs have expense ratios, which are annual fees covering the fund's operating expenses. And the expense ratio is deducted automatically from the fund's return. And then we have sales and trading fees, transaction fees, transfer fees, account maintenance fees. So all of these fees can add up significantly. So it's really important to see how can you reduce your fees so that you can maximize your returns. Overall, I think this is a great book for anyone wanting to understand the history of the stock market and how it works. I think his recommendations are simple enough for any investor to implement. If this resonated with you, drop a comment below. What's your biggest challenge as an investor? Are there any other great books on investing that you've read? Let us know. Thanks for watching and see you next time.